Chapter 15 Law and Regulation Governing Accounting. In this chapter, we cover two main topics. First, about legislation governing financial statements, and then we'll discuss about the international regulation of the accountancy profession. So here, this topic, the focus is on the regulatory environment on the accounting, especially on the financial reporting. So let's start to introduce what is behind law and regulation governing accounting. First, complying with local law is a must for every business or every business organization. So the first principle of doing business is to comply with local law. If a country doesn't allow any gambling activities, to do gambling business in that particular country is not legally accepted or allowed, then the business cannot be survived. So complying with local law is the basic principle and is a must for every business organization. And many countries have enacted legislation controlling the retention and submission of proper accounting records and financial statements. And here, we narrow the scope of legislation on financial accounting or financial reporting. Many countries have their own company law or business law about how the business runs and whether they need to submit any financial statements or accounting records. And for United Kingdom, for example, the retention and submission of proper accounting records or financial statements is required. So let's check. And for a country, there are usually several bodies that companies find themselves accountable to. So first, regulatory bodies. For example, a company house in United Kingdom, it is one of the regulatory bodies in the country. Tax authorities, for sure, and some other authorities that they are the government departments, but not under the regulatory bodies for the companies or for the business and tax authorities. So let's check. In most countries, there is a government department which has been set up to oversee the regulation and accounts of companies. And in United Kingdom, this department is known as Companies House. So for Company House in UK, it's responsible to oversee the regulation and accounts of companies. And for those companies, they register with the Companies House, and they are usually required to submit their financial statements to these bodies so that interested parties can inspect them. And companies may also find to retain and submit certain key documents such as register of shareholders and a register of directors. So here, for like in Companies House in United Kingdom, its responsibility is not just to receive the financial statements. Some of the information can be disclosed by the Companies House to the interest party as well. The purpose may be to inspect those companies. And one of the key functions for Companies House is to have documents like register of shareholders and register of directors. In practice, the companies need to file any changes or amendments of the shareholders or directors to Companies House within a certain period of time. Except for the Companies House, we have another authorities which is responsible in the legislation as well, the tax authorities. And for those companies, even for individuals, they are accountable to the tax authorities in the countries in which they are based. So they have to pay, for example, for the companies, they have to pay the income tax or the profits tax. For individuals, they may pay to the income tax or the salaries tax. And for companies, they have to prepare tax returns for each year, showing the amount of taxable profits they have earned in the period. So it's quite simple and straightforward. For the companies, they need to file the tax return to the tax authorities. If it is the taxable profit, they have to pay tax. And for many countries, businesses will also have to submit returns showing the amount of sales tax, or some called VAT, value added tax, that they owe to the tax authorities. It's another type of tax. For profits tax, it's quite straightforward. If the company make profits, then it have to pay tax against the profits they earned. But for many countries, businesses are subject to different types of tax. And some, like say sales tax. Sales tax is one of the taxes in many countries. When you sell the goods to a customer, the customer has to pay sales tax, for example, but the collector need to file with the tax authorities on how much tax, sales tax it collects from the customers, and it needs to pay back the sales tax on behalf of the customer to the tax authorities. So here is the simple logic. What is the sales tax in many countries in the world? They are happening. For other authorities, it's about the industry specific. And for example, like some companies and business organizations are in regulated industries. So first of all, the industries is highly regulated. And while some form of accounting information is required to produce for the regulator, so it's very specific and not for all companies in the country or in the world. One example is in United Kingdom. We have different industries. Say we have the financial services, and most businesses in the financial services industry handle client money. The issue is because of this business, they handle clients' money. So there's more regulations or legal framework for those businesses in managing or handling clients' money. And the FCA, the Financial Conduct Authority, and the PRA, Prudential Regulation Authority, are public bodies that monitor and control the activities of organizations within this industry to protect clients against failure or poor service. So the main purpose of these additional requirements or additional legal requirements is to protect customer or to protect clients, because for this is the so-called group under the sensitive industries. When the financial service industry have problem because they are handling clients' money, so there's a risk of clients' money that the public money will be gone. For example, they need to protect those clients or protect the public against any failure. So here is one example. Another example is charities, because for charities they have access to public money, and so the Charity Commission is the public body that registers all charities and monitors their activities. In order to protect the donor, charities have to comply the rules or the statements quoted in its constitution, and which body in the society govern those charities. In United Kingdom is the Charity Commission, because for Charity Commission, it's a public body that all the charities should register under this, and this commission, the Charity Commission, is responsible to monitor every registered charity's activities. In some countries, if a charity, they are not registered in any government body, in any government departments, they cannot they cannot ask the people to donate, because is not authorized or not legal in that particular country. So for charities, because it's about the money, they collect the money, and the donor need to know whether the money are spent or invest in the particular subjects they highlight in the, say, in the mission or in their constitution. So the Charity Commission in United Kingdom is responsible to monitor those charities and make sure they are registered and monitored. And the third example here is the utilities. For utilities such as gas and electricity providers, they need to offer a reliable, fair, and safe service across the country. And in United Kingdom, a public body called OFGEM or Ofgem it regulates the activities of these organizations. So here is about the public services to the community or to the public. These utility services, because they are providing the services to the community or to the public as a whole, it affects everybody in the society. So the government would like to step in and to regulate those activities and monitor them. So here you can see for those on the examples we show here, no matter it's the financial services, charities, or utilities, the common thing here is any problem of these industries will affect a lot of people or affect the public, like financial services, because it handles the client's money. So when it collapse or fail, then the problem will go directly into the public. And for utilities as well, because if say for example the gas provider it failed to do the job or even it shut down, then the public cannot have access to the gas. It's a big problem in the society. So the government would like to step in, and for those industry, the industry player, they are required to register under respective government body, so the government can monitor their services and to make sure it is working well. So next, let's start to discuss about the legislation governing financial statements. We just brief about who are interested in the accounting information for each company. Like we are talking about the regulatory bodies, like the company's house in United Kingdom, like the tax authorities and some other authorities. And for companies here, legislation covers not only the need to prepare financial statements, but also how they should be prepared, including issues such as frequency and formats. And in UK, the legislation is known as Companies Act. For Companies Act, there's some key requirements on financial statement. So here, let's just have a brief on those requirements. First, the Company Act in UK requires that financial statements are produced that give a true and fair view of the position and performance of the company. So first of all, the financial statements should be produced to give a true and fair view. In our another class, we explain what is true and fair. It's not the same as accurate. And the financial statements need to follow all appropriate accounting standards. So it's quite straightforward and understood that the financial statements need to comply with all accounting standards or follow the accounting standards. And next, the financial statements contain information of sufficient quantity to satisfy the reasonable expectations of the users. So you cannot put only 2 or 3 lines as say for your financial statements, like the statement of your financial position. For example, you just cannot put assets a number, and then liabilities a number, and then shareholders' equity a number. So 3 lines is not acceptable, because the financial statements are expected to contain information of sufficient quantity to meet the reasonable needs by the reader or by the user. And the financial statements need to follow generally accepted practice. So it's a generally accepted principle on it. And the financial statement should not contain any material misstatements. So the financial statement should give a true and fair view of its status or affairs to the readers or to the user. So we just went through the financial statements, whether the Company Act's requirements on financial statements. So right now we talk about the responsibility of for financial records. And under company legislation, directors are responsible for producing financial statements that give a true and fair view. So remember, here is the key is who is responsible for producing financial statements. It's not the accountant, it's not the finance manager, even it's not the finance director. It's the directors are responsible for producing financial statements that give a true and fair view. The directors here means all director members or all members in the board of directors. It may only have 2 directors, or maybe 5, or maybe even 10 directors. But for those directors, they are all responsible for producing financial statements that give a true and fair view. But many companies would like to delegate the job. It's about the delegation only. So the job is delegated within the company to the finance director or the CFO, the chief financial officer. So in other words, the directors in the board of directors, say the members in the board of directors, they are responsible for producing financial statements or a true and fair view of financial statements. But they can delegate to the finance director or CFO or within the company to do it. But it doesn't mean finance director or the CFO is responsible, because the responsibility is on directors. And the financial reporting function within the accounting department will assist the FD with this. So in other words, the accounting department will help the FD, the finance director, to prepare the financial reports or the financial statements, and the finance director need to review the numbers, need to review the statements before passing to the board of directors to approve, because finally the board of directors are responsible for producing the financial statements. So we talk about the legal requirements on financial statements and also share with you who is responsible or who are responsible for preparing the financial statements. And right now we talk about consequences of not complying. If it is failed to keep proper accounting records or to prepare regular financial statements that give a true and fair view, are both criminal offenses. So here is very important message. If a company cannot meet this or fulfill these requirements, that is, they are not complied with, they are not complied, or they do not comply with it, then it's a criminal offenses. For regulatory bodies or regulatory authorities, the responsibility is that the directors who can be fined for failure to comply, or even not fined, maybe put in jail. And for a listed company, it's very critical, because for the company, if they are listed, their shares traded in the stock exchange may be suspended because they cannot meet this requirement. A lot of stock exchange in the world requires the listed company to publish the annual financial statements within a certain period of time, say 2 months or 3 months after the period end, for example. And all the companies listed should comply with it. If they cannot comply with these requirements, their shares need to be suspended in the stock trading floor. So in other words, the shares cannot be traded. It affects a lot of people, including the investors, including hedge funds, pension funds, many other people as well. So it's a critical consequence if a company, especially a listed company, cannot comply with it. And for tax authorities launch an investigation say if they cannot file any tax return, no tax return within the deadline, we call the tax deadline, they cannot submit the tax return, and the tax authorities will launch an investigation. And if discover that too little tax has been paid, then the company may be guilty of tax evasion, which is illegal. So it's very critical for a company to submit the tax return to tax authorities before the tax deadline. For other authorities, should the company be listed, it may have shares suspended. We just mentioned about it, like the regulatory authorities. And the company's auditors may give a qualified audit report and make it harder and more expensive to raise finance. In another class, we mentioned that the external auditor produced an audit report or unqualified audit report to show as an opinion, because the financial statements give a true and fair view. If an auditor cannot give an unqualified opinion, that means they provide a qualified audit report. It's very hard for the company to raise finance, or even not only additional finance, even for refinancing, because the bank will be in doubt whether the company has any issue or any financial issues that may hurt its future repayment ability. So in-class question time, we have one in-class question here. We have three statements. First, the FD is required by the Company Acts to prepare the financial statements. The second statement, the management accounting session is primarily involved in preparing the financial statements. Third statement, if a firm of accountants may be hired to help with accounts preparation at the end of the year, then they are responsible for them being true and fair. So which of these statements is or are correct? We just mentioned about the consequences of not complying and who are responsible for preparing financial statements. So we mentioned that FD is being delegated, and financial accounting function involved in preparing the financial statements, and also who are responsible for giving true and fair view is more or less the same as statement 1 and statement 3 is more or less the same background or rationale. So for this question, which of these statements is or are correct? I think you can pick the right answer after our discussion in this class.